Hi everyone, my name is Matan Azanov and welcome to my channel. I've been a venture capital investor for about 10 years. And I get asked quite a lot, how do I come to a decision in which companies to invest in? So in this video, I'm going to walk you through 10 things you should never say to an investor while you're trying to seek an investment from them. Let's start off by understanding the way a venture capital investor thinks. Because someone in my position sees thousands of companies and pitches every year, yes, you heard that right, thousands. And we speak to several hundred to make only a couple or a few investments every year. And because of the high volume of opportunities that we see, people in my position create a lot of shortcuts to figure out who they should spend more time with. There is a lot of signaling that is going on when a startup is speaking to a VC. So when I talk about the 10 things you should never say to a VC investor while you're trying to raise money from them, it's because for us, it's a shortcut in determining whether or not it's worthwhile spending more time on you as a potential entrepreneur we can invest in. Now, why that's the case is because we have to make decisions quickly. We have to figure out, is there a realistic chance that we can invest in your startup? Because the process is long, it's expensive, and we only get a few shots every year to make great investments. Because if we spend that time on one particular startup, we can't spend that time on another. So my goal and my job for my own time, and certainly for my team's time, is figure out very quickly who we should spend a lot of time on. So without any further delays, here are the 10 things you should never say to a potential VC investor in order to maximize your chances of success in raising capital. The first thing is never ask for an NDA before sharing some basic information about your business. This is not legal advice. I have a whole separate video that will be linked down below that you can check out about why not to ask for NDAs and maybe sometimes where you should ask for NDAs. But suffice to say for now, if you're just meeting an investor, don't ask for an NDA. You're creating artificial barriers that aren't going to help you raise money. And from my perspective as a VC investor, it's a red flag on you as an entrepreneur. The main reason is that it shows a lack of experience. The way you build a successful business is not by keeping, some basic information about your business hidden. It's by developing a good team and executing quickly and efficiently. That will always win out over someone with better ideas. The second thing you should never say to a potential VC investor is, we don't have any competition. The first thing is you always have competition. If you don't think you have a competition, either there is a lack of demand for your product or service in the market, or you haven't done your research. Second, the main competition, even for something innovative, is the status quo. Your innovation or product or service, if you're looking to beat out your competitors in a crowded market, has to be quite significantly better, not just a marginal improvement. Third, you have to take into account the alternative ways of doing things, not just the status quo, but can someone solve the problem using some alternative method? If you come to a VC investor and say, we don't have any competition because we're the only ones doing this in this particular way, well, who cares? If you can solve the problem in some other way, that's fair game. So never go to a VC and say, we don't have any competition. There are limited circumstances where that's a good answer, but in 99% of cases, it's not. The third thing you should never say to a potential VC investor is, if only we get X% of the market, we'll be a multi-billion-dollar business. Now, you can think that that's a very clever way to do things, but it's not. To get even a small percentage of a large market is very unlikely. You can't just go to someone and say, hey, if we get 1% of a $10 billion market, well, we have $100 million in revenue. That's true, but to get $100 million in revenue is really what you're saying, and that's not easy to do. And just because it's a small part of a big market doesn't mean you can capture it. And even more importantly, capturing a small portion of a large market can actually be more difficult than capturing a large portion of a small market, because capturing a larger portion of a small market enables you to actually develop a very specific vertical focus, a niche, and be able to win out the competition because you developed a very tailor-made focus for that particular market segment. If you're just one of many competitors in a huge market, it actually can be much more difficult to develop any significant market share. So saying this actually shows quite a lack of experience about what you're trying to accomplish in your business, what market you're pursuing, what it means to actually capture market share. So don't do this. And number 4 is trying to create artificial time pressure by saying, hey, we have a lot of interest in our round, so you have to make a decision by X date. Now, it could be true that that may be the case. And if it is the case and you have actual evidence like a signed term sheet, then that's fair game and you should mention it. But most of the time when an entrepreneur is telling us this, they're trying to create artificial time pressure for you to make a decision. My immediate response to that, in almost all cases, is, well, sorry, we have a certain time how we do investments. We do thorough diligence, and that's going to take us a certain amount of weeks or months, and therefore it's just not a good fit. Best of luck and goodbye. This tactic may work in some other sales situations, but not when you're asking for someone to make a large investment in your business. Don't do this. It's a turnoff, and right away it shows us that it's not going to be a good partnership. And I know for most VCs that I've spoken to, this is an automatic no. And number 5 is relying too much on your peers in the market to justify your own valuation or your own expectations. So, for example, if you say, hey, company Y raised money at X valuation and they're so much worse than us, therefore our valuations should be whatever. Now, it sounds like that's a very legitimate way to approach valuation or terms or expectations, but I'll tell you why it's not a good idea. First, the headline numbers you see in articles online are almost never the full story. You don't actually know what goes in to the term sheets that have been offered to those companies. A headline valuation often leaves out other terms that are just as important, like liquidation preferences, like tranche investing, whether or not it's a cap on some convertible loan, or many, many other terms that actually reduce that valuation in practical terms. And the other thing you don't know about those headline numbers is the actual performance of the business. So it could be that that company is performing much better than yours. If you have 2x growth year over year, they may have 4x growth year over year. Their founders may have more experience, or they actually have a better product or service. There are many, many, many reasons why they're getting the valuation they got. And furthermore, the VC will do their own research and determine what is a good and appropriate comparable for valuation. And it's a good negotiating tactic perhaps to provide some information about what others are doing, but relying on that too heavily is almost always going to backfire. Say, the right way to approach this is not to make definitive statements about your competitors, especially whether or not they're worse or whether or not their valuation is an indication of your own valuation, but you can offer it as a helpful data point, which is appreciated sometimes. And number 6 is pretending like your crazy projections are actually conservative projections. So don't say something like this: we are projecting conservatively, and insert crazy projection. I see this all too often, where a founder will put some crazy projection in their financial model and then claim that projection is conservative. And they'll have their reasons. One salesperson, and that salesperson gets one large sale every quarter, and we have 4 salespeople. Well, hey, that means you're getting 4 big sales every quarter, 12 big sales every year. Each sale is worth whatever amount it's worth, and bingo, you have some great projection. Don't do this. Your projections should always be within certain industry standards, within what's the expected growth for a company in your industry and your stage, and taking into account your budget and historical performance. And certainly don't pretend like your crazy projections are conservative. You can have and should have ambitious projections, but don't pretend like they're conservative. A VC will see right through that, and they'll knock that projection down right away in their own modeling, and every analysis they'll do will be based on what they think is the reality. And all you'll do is lose credibility in the process. And number 7, which may be counterintuitive, is telling an investor that you're only looking for value-add investors. Now, it sounds very nice. We don't just want money, we want people that will bring something more to the table, because it shows like we don't just care about your money, we care about something else that you offer. And VCs have unfortunately played a big role in making this, a trend in venture capital and in startupland by suggesting that their value add is something significantly more than the money that they bring to the table. Let me let you in on a little secret. Most VCs' value add is their capital, and should be their capital. That is what they bring to the table. That is their value add. And that's a good thing. Many VCs will add other value, like they'll be an advisor, they'll help you raise money, they'll help you find exit opportunities. Some can even, connect you to potential customers and do a lot more. There are a lot of great VCs out there that do a lot of interesting things, but the main value add a VC will bring to the table is capital. And certainly don't denigrate that by suggesting that someone that just brings capital to the table is not good enough to invest in your company. Ultimately, if you have a lot of options, make your decisions, but don't go to a VC and pretend like if they just bring money to the table, that's not good enough for you. Number 8 is suggesting that you'll get the traction after you raise the money. And I understand the frustrations from founders in this regard. It's like the people that need experience to get the job, but the jobs, even entry level today, require some experience. Like, what are you going to do? You need to raise the money to get the traction, but you can only get the traction after you raise the money. I get it. Now, best entrepreneurs out there will figure this out. By the time they come to a venture investor, they will have found a way to get the traction. They will have found government money, accelerator money, loans. They'll put in their own capital. They will go to friends and family. They will find a way. But one thing you should never do is to suggest that your lack of traction was due to a lack of capital. That is never a good answer for an investor, because they'll ask correctly, well, why didn't you get the capital before you came to me? Why do you want me to take on the riskiest part of you building your company? What you should do is get some traction to begin with and say something more like this. We have, with the amount of capital and the resources we're able to get this much traction. And it should be something material and significant for whatever company you're building. But with your capital, we can hypercharge that growth. Saying something like that is much more effective than just blaming your lack of capital for your lack of traction, which more often than not has nothing to do with the capital, but has more to do with your product, with the way you're selling it, with your team, or something of that nature. Number 9 is pretending like you have recurring revenue when you don't. If you say something like, it's like recurring revenue because we expect the customers to buy it every year. No, incorrect. Recurring revenues is something very specific, where the nature of the product itself renews either contractually, or the nature of the product itself lends itself to be renewed every year. That's why SaaS, software as a service, where effectively you're renting software every year, is true recurring revenue, because as long as everything is going well, the customer will continue buying that product every year at some sort of set price. If you're selling a service that you expect the customer to buy every year, that's not recurring. And don't pretend like it is, because it's a red flag and you lose a lot of credibility. And finally, number 10 is if the founders don't attend the intro calls with VCs. I've seen quite a few times where I get on a call and none of the founders are on that call with me for an intro about their business. And when I ask whoever's on the call with me, they say, well, the founders don't do intro calls, they only do the second or third call. Don't do this. Your job as an entrepreneur and as a founder of a business is to raise capital. That's one of your primary jobs if you run the kind of business that burns capital and relies on VC investors. Don't do this. Attend those meetings. If you don't believe that there's a high chance to get an investment from the VC, then don't schedule the meeting at all. Don't put one of your executives, don't put one of your salespeople, don't do it. Attend these meetings yourself. Well, that's it for today. I hope you learned something from the 10 things never to say to a VC investor if you're looking to raise capital from them. If you like this type of content, like and subscribe. Let me know what you think about this video by leaving a comment down below. And thank you so much for listening.